Good morning, everybody. Thanks for telling everybody I drive a Vespa. uh, no, leave that alone. We'll stick with the Vespa part. Like I said, good morning, everybody. Quite a few familiar faces, some new faces. Hope you all enjoy this interactive presentation. Stephen asked me to talk about, does member investment choice add value? And we're going to go through this journey, and it's like saying, how long is a piece of string? You know, if you believe in it, you say investment choice does, then the string is that long. If you don't, it's simple, one strategy for your fund, then your string is this long. Okay. So hopefully through the presentation, make it more practical. I'm going to use 3 members throughout their lifetime in different environments, and let's see if we can understand what it means. But firstly, let's play a video.
That industry with the express purpose of enriching others, and they're very good at what they do, which is enriching themselves.
Yeah, almost all fund management is a complete rip-off. They only have to look at the prices relative to the performance.
Customer thinks they're actually getting something better. They're actually getting something worse.
The fund manager will end up earning more in fees than that investor will get back in their pockets.
I laugh because I've been telling the same story for 52 years now.
You may as well pick up sporting life and go to new market.
Looking at performance that's almost really good.
The whole financial business is based around making things complicated so they can be expensive.
This is an industry that is a genius at obfuscation and bamboozlement, with terminology that is utterly new.
Great. That was just a little glimpse of what we're going to talk about. So, of course, investment choice, does it add value? It's a couple of direction. Is it like a pack of cards that we give out? You know, the different signs. Do I need advice? Tips. We've heard some of the previous speakers talk about all these issues, guidance. And that's unfortunately what aids to this complexity in our industry. We've created ourselves, obviously, and we've heard this over and over again because it benefits us as the industry and it doesn't benefit the member. So we're going to start working through this and see what is it. So I've asked trustees, principal officers questions. So why do you offer member choice on your fund? And interesting enough, and I must commend them for their honesty, these were some of the answers that came back. Peer pressure. Okay, so as a board of trustees, there's comparisons between funds, between benefit structures, and so because the one fund offers this, we feel we have to offer that. So there's that peer pressure, and that's why we offer it. Member demographics, we believe that we are all different, and we are. Okay, so the way we need and we want is very, very different, so we will cater for our members, assuming that our members know that they are different, their needs and their wants, and what that is. It's the right thing to do. I have an issue with that. I think it's not the right thing to do. But in that fund specific, that's what the trustees felt. It's the right thing to do. And then the underperformance come back. Now, the trustees and the principal officers here in the rooms, the markets are doing exceptionally well. How many people are queuing up outside your door saying it's not doing well enough? No one. But when the funds underperform, how long is that queue? Okay. So that's a reason to say, well, then let's rather cater for everything, and then it's the member's responsibility then to choose, because we don't want to take responsibility when there's that underperformance issue that then comes through. So as mentioned, practical examples. Over 40 years in your life, we have member number 1, and it's his first-time job. So what process is a member going through when he starts his first employment, etc.? Member number 2, he's been working for 10 years, he just starts to change his job and career, he makes the decision, what is that process that that member is going to go through? And the third one, been in the company for 25 years, there was no choice, what happened to that member? And hopefully what we're trying to show is that none of them are any better off at the end. And so we'll take some questions afterwards if you disagree. Full-time job. First time the member gets employed, so he gets an employment contract that stipulates his membership to a retirement fund, and in the induction pack he gets told that this is your administrator, this is your risk provider, and these are your investment platform or investment managers with all these choices that you can choose from. You have a life stage model that you can choose from. It could be active, passive. There can be a combination of the two. It could be single managers, balance funds. Usually the top 5 or the top 11, however much choice they're going to give you. And there's balance funds, there's absolute return funds, and sometimes they include specialist funds within that. And then there's a capital guaranteed fund, because we realize our members don't like to lose their money, so we'll add that in there. And if you don't choose, guess what? You can tick the default option. You're going to default into that life stage model. Okay. So what goes through the member's mind when he gets that in back? Very different, the process, to when the trustees put the choices there. So now the member has to deal with this induction pack. So what is in there? It's a form to tick. Which one of these portfolios am I going to invest in? And these are some of the things that would go through that members. How do I choose? It's the first time I'm employing. So we assume here the member is relatively young. Okay. Never been exposed to this, but yet I'm expected to make a choice as to where I'm going to put my monthly contributions into. Let me ask a colleague, my spouse, or HR. Okay. Does that sound familiar? Any HR people here? Anyone? Yeah. Lots. Okay. Who was the best performing manager last year? Remember this question. Okay. I just don't know. It's not important right now. Remember, I'm fairly young. It's my first job. It's not important. I'll get to know about these things, and next year I'll do it, or whenever. But what happens? The member forgets. Okay, leaves it there. And often when we talk at member presentations, we ask the members, do you know where you invested? No. What are some of the feedback? It's too complicated. We can't get into the system. They give us access. There's online, you register, your PIN and your password. It's too complicated. So then we don't help the member actually get to where it is. So it is then in the default option. So let's go to member 2. Okay. After 10 years, this member decides to change his job, change careers, and now he's going through this process. Exit process. Okay. Again, the member gets given a pack. Number of investment choices that you can put your money when you leave, but also you can transfer to the next fund, you can preserve, or you can take your money in cash. Now the statistic speaks for itself. Members take their money in cash, and we've all heard from regulatory bodies this morning that they're trying to prevent that from happening. Okay, so but this member specifically chooses to preserve with service provider A, and the platform offers 700 portfolio options. How on earth is that possible? Think about it. There's about 110 companies that you can invest in, all these different portfolios. Just doesn't make sense. Okay. What goes through the member's mind? Okay, how do I know? Or how should I invest this money that sits in this preservation fund? Past performance. Who did well last year? Maybe I should go there in that fund. Okay. But also I've heard about diversification. So maybe I should split this preservation fund of mine. So maybe I should give it to 2 managers rather than just keeping it all with 1 manager. So those are some of the thoughts that goes through your mind. But we're still with member number 2. And I want to give you some examples. In the last 6 months, as we grow as a business, we're dealing with 2 of these scenarios. Member takes out an RA, 12 different underlying asset manager portfolios in this retirement annuity. The average cost for this individual holding these 12 portfolios, 2.63%. Okay. If you take that choice element out of it, or you at least half it, okay, you'll be able to get a better performance. And what the member asked us was, that's fine if we transfer it into the index fund, etc., but what's going to happen to my performance? See how we are conditioned to think that it's about performance, but not about the cost element, that I've got 12 portfolios. Now, interesting, I went into these 12 portfolios to understand what it is. Within one manager, there were 4 portfolios that this individual chose. A top 20, an aggressive fund, a balance fund, and then one of the cash funds. In one house, there were 4, the manager was represented 4 times within that. It's ludicrous. Okay, just thinking about it, but we don't know. We don't know any different as the member. This is what gets given to you, and then these are the choices that we make. Member number 2, he decides he's going to preserve this money from this company, and he chooses platform A. I had a discussion with a member, and he's in the room, so if you want to ask him questions afterwards, you can check that it's correct. I said, so how come you chose this platform? It was in my exit pack. That's it. He did the right thing by preserving. Somebody put a preservation form in that pack, and so he's just going to go that route and selecting. So he selected 2 balance managers, 2 of the largest houses currently. And I asked him, but why? Why did you choose that specifically? Was there an advisor involved? He says, yeah, there's some commission, there's some payment, this and whatever. But, I need to diversify. I can't have my eggs in one basket. Past performance have been quite good, and specifically with the one, they had this ad campaign, where there was a pot of gold at the end of the rainbow. Okay. So the moral of the story is there is a pot of gold at the end of the rainbow, but how big is that pot? Okay, and that's what we need to understand. By having too much choice, too much cost, we make that pot smaller. We've got to increase that pot. It's your money. It's my money at the end of the day. So just, again, taking out that cost, this member will be able to retire with 800,000 Rand more. That's a lot of money. I haven't yet, in all walks of life, doesn't matter if you're poor, if you're middle class, or whether you're wealthy, 800,000 Rand is a lot of money. That said, no, thank you. I'd rather stay where I am. I'll pay all these fees, and I'll retire with 800 less at the end of the day. Okay. So those are some of the complications. So we're still with member number 2, because now remember, he's resigned. He's gone through this exit process. Some of them take up the preservation fund, and now he gets to his new employer, and we repeat this whole process again. It goes through to induction. You get your form, and now I've got to choose again which funds am I going to go into. But by now, the member should know. Yes? No? Have more knowledge? Yes? No? Still not. There's a view over here. No, we still don't know. That's right, we still don't know. Okay, because it's our own fault. We don't take responsibility, but also there's just too much information that comes our way. Okay, so the member now realizes he's got to be in an umbrella fund. There's 200 investment options. He goes, phew, I've gone from 700 to 200. Okay, again, we're going to tick the default option because I just don't know. I don't know what's going on here. And then if you don't want to do that, you can contact your consultant or your advisor, and they will be able to take you through which option you should invest in. Okay, complications. So again, the member goes through these thought processes. Okay, why can't I have the same portfolio as before? Or at least if I knew what my asset allocation was, at least I can then choose something that's similar in then I can continue with my investment strategy. Do I need to pay for the advice? Because they say there's consultants and advice, or how does this work? What is the difference between all these portfolios? So if they're going to give me 200, I can basically classify it in aggressive, moderate, and conservative. Tell me there's 200 funds that can do these things for me. Why do I have all these options? Who was the best performing manager last year? This question repeats itself over and over and over, because that's all we've got. That's the only tangible thing we think we have as members when we make decisions on where to invest our money, as we go to what was last year or what was best then. So I still don't know, so I'll just go into the default option again. Okay. Let's go to member number 3. Okay. 25 years of service within the same company, and within this member, they had limited choice. Okay, the company, the board of trustees, took a view as to say, we're going to limit the members on this fund, and we're going to give you an aggressive, a moderate, and a conservative portfolio to invest in. Okay, the member chooses to have 50% in aggressive and 50% in conservative. Who has seen that? How many of your members are doing that? Okay, again, we diversify. Okay, I've heard it somewhere. Okay, we need to diversify. Okay, can't have all my eggs in one basket. What is the end result? He ends up with a moderate portfolio, more or less 50% in equity, but twice the cost. Okay. Now, did we do any service to this member or help them to achieve their retirement outcome at the end of the day? So the conclusion then is to say, in all 3 scenarios, the member did not meet the retirement objective. A, too much information, couldn't work out where that money has to be. And also, it's ignored the basic investment principles. Rather than saying, my time period for investment, where should I start? Okay. The mandate of the different portfolio, or the portfolio that I should be in, and then the cost associated with that. Now, surely this information should be in the induction pack and shouldn't be left up to the member to work out if and when they have the time to work these things out for themselves. Okay. Statistics also tells us that 85% of members are on a default option. That's conservatively. I think it's more than 90% of members that tick the default option. So if that is what statistics tells us, then why do we still offer all these choices on our funds? The direct and indirect costs of all these choices, lack of transparency. So if you as a member, you go into the default option and there's all these 200 other funds or portfolios that are available, you still pay for it. Whether you actually use it or whether you don't, you still pay for it. So if you believe at a board of trustee level that we should actually have choice, and it's a good thing that people can choose for the different portfolios, then let that member pay for it. Don't let everybody pay for it. That would be a better scenario to protect your growth at the end of the day. A recent article in Personal Finance, this comment was made. At 35, a member can pay as much as 45% of total fees to the asset manager, and as much as 82% 30 years later. It's ludicrous. Okay, so we need to understand what we pay for and why we pay for it. So the question then at the end of the day is, if an asset manager or a platform has conviction about what they're trying to give or give to the member, then surely they should have one portfolio. Max 2 portfolios within that. In my previous employer, where I used to work, huge portfolio offering that they offered to clients, for us as staff, to invest in that as well. Only one portfolio, by and large, got all the assets. It shows you that that's where the money will go. So why offer everything else? It just becomes you add to the cost layer within that.
Fund managers are the rock stars of the investment world. They command huge salaries and their names are all over the financial media. But do they really deserve their stellar status? Well, new research suggests that 99% of them don't. Researchers at the Pensions Institute, based at Cass Business School in London, examined 516 UK equity funds between 1998 and 2008 and found that just 1% of managers were able to return more than the trading and operating costs they incurred. But even those managers pocketed for themselves any value they added in fees, leaving nothing for the investor. All the other managers failed to deliver any outperformance, either from stock selection or market timing. Now, as we've said before, the evidence suggests that luck often plays a bigger part in investment returns than skill. So let's be charitable. Perhaps the remaining 99% of managers were simply unlucky. Well, the study was conducted using a statistical technique called bootstrapping, which allowed the researchers to isolate returns which a manager could only have achieved by luck. Their conclusion was that the vast majority of managers weren't just unlucky, they were genuinely unskilled. So there are real stars out there, but they represent only a tiny fraction of fund managers. The challenge, of course, is working out who the top performers are going to be over, say, the next 10 or 20 years. Star managers are, to quote the report, incredibly hard to identify. Furthermore, it takes 22 years of performance data to be 90% sure that a particular manager's outperformance is genuinely down to skill. For most investors, the report concludes, it's simply not worth paying the vast majority of fund managers that actively manage their assets. This report clearly makes very uncomfortable reading for the fund management industry. It's awkward too for most financial advisors who built their businesses around the idea that successful investing is all about picking the right manager. The good news, though, is that you don't need to pay over the odds for an active manager who will most likely fail to outperform anyway.
Thank you for your time.